It's Paul Brown here from Wealth21. With all the volatility in the market, I thought it would be a good time to do an update on all of the markets. Firstly and importantly, any information here is factual and general in basis, so there's no doesn't take into account your specific circumstances. If you do have questions that relate to your specific circumstances, feel free to give me a call. So let's move through. Firstly, we'll have a look at some charts. This information is based on the closing prices on Friday, the 6th of March as well. So this is a 2-year chart of the ASX 200, the Australian share market, and we have experienced a 13% correction in just 11 trading days, which is a very short period of time. We did experience a 14% correction towards the end of 2018 as well. That was over 81 trading days though, so over a much longer time frame. So looking at a longer term chart, now this is actually a 20-year chart, and they're the two corrections I was just speaking about. Of course, some corrections and rises in the market are a part of the share market. This correction here was very significant, of course, and that was in fact a 54% correction in the Australian share market due to the GFC over 340 trading days, so over more than a year. And by the way, this little dip down here in 2003 was actually the SARS virus. Okay, so moving on, this is the US share market. Very similar trend. They've had a 13% correction over just 7 trading days. So again, like Australia, a very short time frame. And their correction in the fourth quarter of 2018 was actually 20%, but over 57 trading days. Just look at the bond rate now. So what happens when there's fear in the market is investors tend to rush to bonds. The price of bonds goes up, and so the bond rate or the yield on bonds reduces. So the 10-year bond rate at the start of January around here was 1.4%, and that's now reduced to 0.65% over a very short period of time. Okay, so looking more long term at the bond rate over the past 10 years, it has actually reduced significantly over the past decade, from as much as 5.8% in January 2010 to the current level, which is just 0.65%. So just looking at the economic impact of COVID-19 or the coronavirus, global trade, supply chain disruption, restrictions on travel, which impacts, of course, companies like airlines and travel companies, impact on earnings and also earnings growth. Okay, there's fears of a global economic slowdown or potentially a recession. So the central banks have responded. The Australian Reserve Bank, the Reserve Bank of Australia, reduced interest rates from 0.75% to 0.5% last week, and we've seen similar reduction in interest rates from US and central banks around the world. We should also expect governments to provide stimulus into the economy as well. Okay, some comments from the Centrepoint research team. The speed of the correction is unprecedented, as we've spoken about. It's not the biggest correction we've seen, but it's a correction over a very short time frame. Okay, so PIMCO, which is a global bond manager, expects first quarter GDP in China to contract by as much as 6%. However, global share markets were close to record highs just a few weeks ago, and volatility has actually been well below average over recent years. The lesson from SARS, which was in 2002, 2003, the markets recovered when peak cases started to decline, meaning the number of new cases, when that number started to decline, the market started to recover. Okay, so despite the correction, this is from Centrepoint Research, despite the correction, an allocation from growth assets to cash could cost portfolios dearly over the longer run. So there we go. That's an update on the markets. If you have any questions or concerns, please feel free to call me 5445 3441 or email paul@wealth21.com.au. Thanks for listening.